Welcome to Market Domination Overtime. Stocks close higher, and our very own Jared Brickery is over at the big monitor with the headlines. Jared, we're seeing some small records today. Break down what happened during today's trading session.
Oh, we got small records, we got big records, we got mid-sized records. Okay, check this out. S&P 500 record high. It's only up 11 points or 16 basis points. Very small amount, but that's good enough for a record. Meanwhile, we got the S&P 600. That is small caps, and I'll show you the intraday chart. This is the first record high since November of 2024, and not shown here because I don't have it on the list, is the S&P 400. That's mid caps. That's also at a record. I don't know when the last time all three of those hit a record on the same date, but somewhat noteworthy. In addition, the S&P 500 equal weight, calculated differently than the normal S&P 500, that was barely up too, but that was good enough for a record. Meanwhile, the Dow, also a record. NASDAQ, not a record, and it was up the most, about 0.25%. So we're not talking about big gains here by any stretch, but a lot of records to go around. One more, microcaps as well. So from the very smallest to the biggest. If that's not breadth, I don't know what is. And let's check in on the sector action here, shall we? And these are all large cap sectors, and we were led by staples. That's pretty interesting. Haven't seen staples lead in a while. Second to that is industrials, and we got materials, tech, real estate, utilities. That rounds out the top row there. Then on the bottom, the very worst off today was financials. Large cap financials down about 0.8%, followed by energy and then communication services. So let's check out the NASDAQ 100 here. And there we go. We can see not a big gainer for NVIDIA, but it is positive. Alphabet up 1%, Broadcom up 2%. The chip stock index, the Philly chip index, the SOX as they call it, that was up to a record as well. And you do see a bit of red in here. So I'm going to break it down by chip stocks and then software. Here's what the chip stocks did today. You can see a lot of green, especially in some of the bigger names, AMD and Taiwan Semi, each of those up 2%. But Intel here down 3%. Analog Digital, Qualcomm down almost 5%. A lot of the smaller names just not doing it today. And then here's the software look. And here we see Microsoft. That's the biggest one, kind of obscuring things. That was down, but I'll show you the equal weighted view. We got a little bit more green than red. To the upside, we got UiPath. That's up 5% today. And then to the downside, we got Teladoc. That was down about 2.5%. I'm going to leave us off on the Dow, and here we see to the right, because we already covered the mega caps, some outperformers. Walmart was up 3%. J&J, that's that Staples name. Again, Staples was leading. J&J up 2.5%. Procter & Gamble up 1%. And looks like Boeing up 2% as well. So I'll send it back to you, Brooke.
Jared, thank you so much. The S&P 500 notching a new record as investors shake off concerns over the Trump administration, whether it's Fed independence or the threat to banks to cap rates. Joining me now is Scott Ladner. He's Horizon Chief Investment Officer. Scott, it seems like this went from being a trade of sell America to a trade of buy the dip. Walk us through what we saw during today's trading session.
Yeah, hey, Brooke. Look, when we walked in, and certainly last night and walking in this morning, it didn't look very, very pretty. It didn't look pretty because Trump had, come out and, or at least the Trump administration come out and said, listen, Jerome Powell, you're on notice, and threatening with jail time. And what was striking was Powell's response to the entire episode. Powell's basically turned a blind eye and sort of like played nice with all the threats that have been coming his way, and he chose a very different path this time, and I think a relatively credible path. And ultimately, that's what I think ended up turning the market as people decided that, listen, if Trump really wants to push the envelope here, it's not going to end up being the right thing to do. And he's got Bessent in his ear telling him it's the wrong thing to do in a really kind of ham-fisted way to approach something like this. And deciding that, listen, this is really going to go nowhere. And so, that's that. Once the market decided that the Trump, the Powell threats really didn't have any legs, that basically cleared us up to go and buy and at least get back to around even for the day. It was rather slow day other than those early morning fireworks.
Scott, you had wrote in your note that a boring Fed is a good Fed for 2026. We're expecting new data out around CPI tomorrow. We got that cooler jobs data last week. What does this mean moving forward, and why is boring in vogue these days?
But boring's a vogue these days because if we can start talking about all the wonderful things that are happening both in the economy and at the corporate sector level overall, we can stop thinking about what is this next 25 basis point move going to do from the Fed and really sort of like just take that conversation, taking all the air out of the room. A boring Fed is a good Fed because that means that that their job is done, that we have relatively stable inflation, relatively stable employment situation, and when that's the case, market tends to do pretty well historically, and it makes sense that it should. So we as you said earlier, we got employment information last week that was pretty Goldilocksy, not too hot, not too cold. It was fine. We expect to get CPI numbers tomorrow that are also going to be pretty noiseless and like not very exciting. And if that's the case, then the Fed is free to do nothing for a while, which would be end up being a wonderful thing for this market.
Scott, you do think that 2025 is all about the AI trade, and you expect it to sort of expand to the other horizons in 2026. We are seeing a bit of rotation here. Materials, industrials, energy, consumer staples even gaining some momentum year to date. What do you make of this, and what's your message to investors here?
Brooke, that is generally my message. The last couple of years has been about the building of AI capabilities. The next couple of years, including this year, is going to be all about the diffusion of those AI capabilities throughout the entire economy. And that means that other companies, other than NVIDIA and some of the very large mega caps, can participate in this AI-led, productivity-led rally. And this ends up being a fairly important thing when you consider all the tailwinds that this economy has and all the tailwinds that the market has at its back as we enter 2026. From stimulus from the private sector with respect to CapEx builds, stimulus from the public sector with respect to tax refund checks and CapEx expensing. All of those types of things point to a run it hot, high nominal GDP growth type of environment. And that's the kind of environment that you want cyclical exposure. You want value type of exposure. It's not the kind of environment that we've had over the last couple of years where all you wanted is the very top of the market when growth has been challenged. When growth is abundant and it's no longer scarce, you want to get those stocks and those types of sectors that are really exposed to sharply higher nominal GDP growth. And that's going to be those value cyclical sectors. And another way to play that is just in the broadening out of kind of an equal weight play. If you don't want to get too cute in sectors, just buy the equal weight instead of market cap weight this year.
Scott Ladner, thank you so much for joining us. Appreciate it. And banks are set to report earnings for the most recent quarter this week, with JP Morgan Chase kicking things off on Tuesday. Clouding the picture is a new call from President Trump for credit card issuers to cap the interest rates they charge at 10%. Jared Cassidy, RBC Capital Markets analyst, joined Market Catalyst this morning to discuss the impact this could have on the sector.
We were hoping to have a more focused conversation about what the fourth quarter earnings, but this news certainly takes priority. And at this point, it's going to be very interesting because it's our understanding, obviously, through an executive order, the credit card companies are not going to be required to lower their credit card rates to 10%. It either has to come through legislation in Congress or codified through the regulators, similar to the Credit Card Act of 2009 that came through Congress. And so it is certainly weighing on the stocks today. Clearly, this president understands we obviously have midterm elections. And as we saw with the election of the mayor in New York City, costs of living is a real talking point for the Democrats. And so if this is a way for the president to try to bring down, the costs for consumers, it's a political strategy on their part. But it would have real negative repercussions for many borrowers, because if the banks were actually forced to lower their credit card rates to 10%, certain borrowers would not qualify for credit cards and would affect the economy, and affected, of course, negatively. So right now, it's in the early innings, of course. We're not, and the stocks are now starting to recover a bit from the early sell-off. We do not expect this to go through, and we do not, it'll be political fodder for probably the next couple of months, but we don't expect anything to really come from this where the banks are actually forced to lower rates to 10%.
And Gerard, just to be clear here about why you think it would be bad for borrowers, I mean, basically, would you expect, if this happened, would you expect the banks to basically say, to limit the number of people who they would approve for credit cards if they can't recoup the cost of that risk through charging a higher rate?
You put your finger right on it correctly. And so you look at some of these card companies that have 5, 6, 7% credit losses. And if you lower the credit card rate to 10%, how are they won't make money. The cost of running their operations is greater than 3% of total of that yield. And if you've got losses again of 5, 6, 7%, you're barely going to break even and probably lose money in some cases. So why lend? And so there would be a real dialing back to the higher risk borrowers who tend to be the borrowers on credit cards that revolve and use those revolving natures of those cards to get them through maybe more difficult times. So it would shrink the amount of growth in consumer spending likely because there'd be less originations of credit cards.
Okay, so that business aside, now we can turn back to the main event, which is looking ahead to some of these earnings reports. And I know one of the highlights is going to be the trading revenues. We've already gotten some hints on those, and just the capital markets business as well generally, which is expected to be strong. I guess the question is the sustainability of that strength through this year, Gerard. What are you expecting?
Assuming the U.S. economy continues to grow at around 2 to 2.5%, you probably saw last week, like many of us, the Federal Reserve out of Atlanta does the real GDP now forecast, which forecasts the current period's real GDP number. And so they, with the trade numbers that came in much better than expected on the deficit, they are now looking for 5% real GDP growth, which is obviously not likely. But the point is, we should see good growth in 2026. Let's call it 2 to 2.5%. Clearly, this administration, contrary to this credit card issue, they have been very supportive of many industries in deregulation, allowing M&A activity to go through. So I think what you're going to hear regarding the capital markets outlook is that investment banking pipelines for mergers and acquisitions remain full, even though we had a decent ECM market, equity capital markets, in 2025. The IPO market was not really that robust, and there are some big IPOs potentially this year. So I think you're going to hear about that as well. And then when it comes to debt capital markets, we had a record year in 2025. This year has gotten off to a very strong start. So I think you're going to hear some real positive comments about the outlook for 26. And trading is more difficult to predict. It's a bigger part of the capital markets revenue stream, and volatility certainly is what trading revenues benefit from. So we're seeing volatility obviously today. So I think the outlook for trading will be good, but the investment banking commentary should be real good. So I think you're going to see strong numbers in the fourth quarter of 25, and then the outlook for 26 is going to be good. But here's an interesting observation for you, is that the so-called second derivative, the rate of change, it's going to be increasingly more difficult for the capital market players to show really strong year-over-year earnings growth numbers in the second half of 26 to the second half of 25, because the comparisons for investment banking and trading are going to be really more difficult in the second half of the year than the first half of the year.
Now time for some of today's trending tickers, starting with Alibaba. The stock surging in today's trade amid a probe into the food delivery space. The nation's top antitrust body launched a probe into competition practices in the industry. This move lifting hopes that increased scrutiny will curb price wars and be supportive of industry margins. Now, the investigation will involve on-site checks, interviews, and questionnaires to gain an in-depth understanding of the competitive conduct of these platforms. Turning now to Walmart, the retailer and Google share plans to launch a new shopping experience. The experience is built by Walmart and accessible directly within Gemini, the AI tool. The launch is first taking place here in the U.S. and internationally thereafter. And this comes as Walmart also gears up to join the NASDAQ 100 index, replacing AstraZeneca. The changes will take effect before the market opens on January 20th. Lastly, Citigroup is reportedly set to cut about 1,000 jobs this week. That's according to Bloomberg. This is part of CEO Jane Fraser's goal to manage costs and improve returns. This is all part of Citi's plan announced by the company about 2 years ago to eliminate 20,000 jobs by the end of 2026. And coming up, we get an analyst take on the top tech stocks to watch in 2026. That's next on Market Domination Overtime. A busy day for Meta, the social media giant, announcing a new AI effort focused on compute to scale its infrastructure. And it's named longtime banker and former Trump administration official Dina Powell McCormick as vice chair. All this as the company leans into AI. Its efforts on reality labs are taking a back seat and reportedly coming with job cuts. That's according to the New York Times, that Meta will cut about 10% of employees within that division. Joining me now is Brent Thill, Jefferies Senior Analyst. Brent, Meta is one of your top picks for 2026. What do you make of all these announcements just out today?
Yeah, I mean, there's a lot to digest. I think the big one that everyone is worried about is the Meta Compute Initiative, which Mark Zuckerberg said it will be measured in the tens of thousands of gigawatts, or tens of gigawatts, upwards of hundreds of thousands of gigawatts. And when you measure a gigawatt to build out, it can be upwards of 40 billion. So just, to get to tens of gigawatts by the end of the decade is like a $400 billion investment per our math. And they're going to spend about $100 billion in CapEx in the next year. So I think everyone is, what does this mean for the cost structure? When's the ROI going to come in? They're clearly, on the flip side, I think they've seen great ROI from their advertisers. They're hiring, obviously the hire they made today, very high quality individual that got the backing of President Trump. So, that's great to see. And I think advertisers are still really excited about what they're doing. But I think the worry is like, what's next? What are they going to do? Like, what are the new initiatives that they're going to be building out that's going to require this kind of compute? And so the pushback we get is, okay, they're going to spend all this money, they're hiring these great people, but when is the return going to come? What does it look like? And they kind of left us with a little bit of a cliffhanger. The last time they said on their guidance, they said, we don't really know the number, we're going to spend a lot, but we'll come back to you with the specific number. So it's right now, there's a lot of news on both sides. Like if they're laying off people in the Reality Labs division, people like it. If they're hiring the people that they hired today, they like it. Then you've got the other side, the cost structure is worrying. So I'd just say overall, bigger picture, Meta is the most hated name in the internet right now. Google and Amazon are the most loved. And the playbook says you buy the most hated name on sentiment, and it usually works. Remember what happened to Google beginning of last year. Everyone hated it, and the stock had the biggest year-to-date gain. We think Meta right now, it's pretty negative. But I think the bigger picture is like it's very positive what they're doing. When you kind of peel back all these layers, we like what they're doing in the strategy.
Brent, what should investors be listening for within this earnings call? You even called out that $100 billion spend is a little bit worrisome there.
Yeah, I mean, it's largely the spend and CapEx. So where is the spend going to go? How much are they going to spend? Again, they launched this Meta Compute Initiative, and it was kind of like you had to put some your own interpretation, right? So you can argue what a gigawatt takes, but he's saying hundreds of gigawatts, up from tens of gigawatts. So again, at the low end, that's $400 billion of investment, and it could go up to way higher. And so I think it's just trying to put that in perspective of what they're willing to spend, why they're confident. I think they're so confident in this ROI from the spend now, because remember 4 or 5 years ago, people were like, why are you spending so much? What are you doing with all this money? And look at what they did. They drove, double-digit revenue growth, great margins. They've had incredible return for advertisers. So I think their view is, look, we went through this dance with Wall Street before. We told you we're going to spend. We know where the future is going. Trust us. They're not giving you every detail. So I think it's really on the cost side as well as what's happening in the advertising environment right now. It's been really good. The environment, the macro environment's good. You have some big events that are happening this year, obviously the World Cup and others that will help drive spend to the platform. But I think it's a combination of what's happening on the ad front combined with these big investments in AI, how that pays out, and what's the actual number. Because they said we're gonna tell you more, but we're not gonna give you all the details. We're gonna kind of give you a ballpark range. So we need to tighten up that range. So I'd say number one thing is where are all these dollars flowing in AI?
Brent, I do want to get to another one of your top picks, and that is Microsoft. You've said within your note that you think it's best positioned large cap to capture the broadest AI tailwinds. Walk us through that take.
So Microsoft started the AI push long before anyone in the enterprise. Their CEO declared in the age of AI. And when we look at Microsoft's portfolio, we've said this, that they have the best platform to monetize AI and the biggest landscape to monetize AI of any software company we cover. So if you look at every day, there are billions of people that sit down at their office and engage with the Microsoft Office applications, Outlook, Word, PowerPoint, Excel. There's an incredible amount of data that's been built up that needs to get intelligence from that. So they can monetize the application layer. They can monetize their infrastructure layer, which is broadly defined as Azure. They have a security business. They have a custom software build business with Power Apps. They have an off-the-shelf business to build CRM and ERP financial systems to let companies run. They can monetize AI through that. So they have this incredible, landscape where they can go out and they can monetize in so many ways. No one has that exposure from apps to infrastructure to security. And so they have this ability to go in and sell AI throughout those portfolios. The second thing is I think they've been a thought leader. They partnered with OpenAI, obviously, early. They built out a lot of these feature sets. They were the first ones to come out with a Copilot model. They're also releasing their own agents. So I go back to, I think they have a lot of the products. They have a lot of the existing infrastructure. They have one of the best management teams we cover. And in the last 2 years, they've had double-digit revenue growth. They've improved operating margins, even with all the big investments in AI. And we think, again, they have the data, they have the users, they have the capital, and they have the existing frameworks to do this. So there's a lot of vendors that are going to benefit with AI. But I think Microsoft is like one where I just sleep well at night with the quality of that team, the quality of the strategy and execution has been really, really good.
And Brent will certainly be watching to see if OpenAI does go public this year. Brent, thank you so much for joining us.
Thank you.
Time now for what to watch on Tuesday, January 13th, starting with earnings. Fourth quarter earnings season gets underway with results from JP Morgan, the Bank of New York Mellon, and Delta Airlines. JP Morgan is the first of the big banks to report its quarterly results this week. The firm is expected to reveal another year of record revenue and profits. Meanwhile, Delta will also be among the first major airlines reporting, helping set the tone for the travel sector. And on the economic front, a new read on inflation is set to be released on Tuesday morning with the Consumer Price Index report. Economists expecting inflation to climb 0.3% from the prior month and rise 2.7% year over year. This week's update on inflation in December will test rate cut bets. Markets are overwhelmingly betting on no rate cuts from the Fed. And on the housing front, an update on sales on new single-family homes. New home sales for October are expected to see a dip to a seasonally adjusted annual rate of 715,000. That would be an estimated decline of 10.6% from the prior month. And sticking with the economy, President Trump is set to speak in Detroit after the Michigan Economic Outlook meeting. Trump is scheduled to speak at 2 p.m. Eastern Time to members of the Detroit Economic Club. Well, that'll do it for today's Market Domination Overtime, but don't go anywhere. On the other side of this break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories. Stay tuned.